Good morning, everybody. Hopefully, you can hear me. Thank you very, very much to Anna for a very well put together, interesting, sobering presentation. Um, I have had the pleasure of working with Anna for a while now, and I have no doubts about her knowledge in these areas. And as Anna has said previously, um, she is definitely the person I would call upon when I need support for my clients in areas that are outside my own knowledge space. And I tend to stay in my lane because I find that it's less crowded and you have less risk of crashing when you do that. Okay, we've had a lot discussed so far, and I have no doubt that everybody's heads are fried at this point. But I'm going to try and, like Anna, to focus in on the real-time implications to companies and look at the practical steps that companies can take. And my focus is very much going to be around the imports coming into Northern Ireland, as opposed to the area that Anna covered, which were exports. I never thought I would say this, but having listened to the presentation and having worked in these areas for the last number of weeks, I kind of find that Northern Ireland rules and procedures aren't now as complicated as I first thought they were, and that, you know what, in reality, once we get to grips with it, we probably can find that we can work through them and work closely with our contacts in government, in HMRC and DBT and all the other departments. Um, I was looking at the delegate list beforehand in terms of um, size, company size, and the if they were defined as exporters, importers, or both. And I seen that for those who had included or um, provided this information, 54% of the delegates today are exporters only. 42% are both exporters and importers. And then we had about 2.5%, 3% that indicated that they were importers only, albeit that I think that if we consider indirect movements of US goods, we would find that figure, that percentage would rise. So if you can go to my next slide. This is just the hands up at the very beginning. As Anna has already stated, a lot of this is very, very fluid. It doesn't matter if you are dealing with this on a full-time basis like myself and Anna, or there's things that we will miss. There's updates that will happen that we may not have found out about. I was doing an event with InvestNI, a briefing meeting on Monday in house, and I was given some information by one of the attendees, and thank you for that, Claire, with regards to changes on the de minimis allowance and how that is calculated and the period it was calculated, which I was able to then go back and confirm with my contacts in HMRC. But I had missed it because we can only have our eyes on one or two things at the same time. So that's my disclaimer. It's very, very fluid at the moment, and I just want to ensure that everybody knows that we're trying to provide as up-to-date information as we can, albeit that things change very, very quickly. Next slide, please. So today I'm going to talk about, as I said, the countermeasures announced by the UK and EU and why that is important. Okay, we're all talking about what President Trump and the US administration have done in terms of imports into the United States, but there is potential for countermeasures, and that impacts businesses. So if we go to the next slide, please. First one we're going to look at is the EU countermeasures. So first thing to say is that there is no EU countermeasures at the moment, albeit that on Monday of this week, the EU produced or adopted some arrangements which were immediately then paused until the 14th of July 2025. So 90 days exactly from the date that they were announced. And that was to be able to provide some time and space for the European Union and the US administration to negotiate some sort of trade agreement. I read yesterday that Šefčovič has been out now 3 times in the last 6 weeks to the US, so it's clear that they are negotiating and working with that. Other things that was noticeable in the documentation that was published in the last few days is that there is now a maximum tariff being applied under these measures that have been currently paused for 90 days of 25%. And I know that the slides will be shared afterwards, and the highlighted areas have links directly through to the relevant documentation. Can we go to the next slide, please? The UK countermeasures. The UK have taken a more restrained and pragmatic approach at the moment, albeit that on the 3rd of April, they produced a document which had an indicative product list of US products that they may open up to countermeasures against the US, as in US origin goods. That read to 400 odd pages, if I recall correctly, and that has gone out to industry for their comments and their review. They also announced on Monday of this week, Sunday, Monday of this week, that they were suspending import tariffs on a range of products to lower costs for businesses. Now, why is that relevant? It's not a huge list. It's about 99 or so commodity codes are in that. But and that suspension is not just in terms of US imports, but all imports of products into the UK. So that is a suspension of the tariffs until July 2027 on the UK global tariff schedule. And that has relevance for Northern Ireland, and I will come back to that later on in my slides in what relevance it has. Can we move to the next slide, please? Apologies, I only set my timer now, so I'm going to try and stick to it. So look, I've talked about UK countermeasures. I've talked about EU countermeasures. You know what? That's really, really confusing for everybody. Why am I talking about EU countermeasures when we're in Northern Ireland? We're part of the United Kingdom. So the reason I'm talking about it, if we go to the next slide, please, is that whilst the whole of the United Kingdom left the European Union on the 1st of January 2021, including Northern Ireland, if we look at the next slide, please, under the arrangements that were negotiated as part of the withdrawal agreement and under the Northern Ireland Protocol, aka the Windsor Framework, Northern Ireland continues to retain access to the European Union for goods. If we have moved to the next slide, please. And that means that we have dual market access, and that's dual market access for goods. Dual market access for goods means that we do not, unlike the rest of the United Kingdom, when goods move between Northern Ireland and the European Union, there is no requirement to complete customs declarations. There's no requirements around preferential origin and rules of origin if you are looking to get preferential rates under the UK-EU Trade and Cooperation Agreement. And because Articles 30 and 110 of the undertaking, TUPE undertaking for protection of the European Union continue to apply in the United Kingdom in respect of Northern Ireland, there is no payment of tariffs on those goods. and that required regulatory alignment in specific areas around goods. And that means that there is requirements placed on us. So the flip side of continuing to get access to a market of 455 million, combined with our dual market access with our own internal UK market, giving us access to a market of about 518 million people. A single market, the largest in the world, incidentally, and a single market which is larger than the US and Japan combined. There is some conditions placed on it. And the conditions are that when goods come in from Great Britain to Northern Ireland, if they are at risk of entering the EU, that there is a requirement to complete customs declarations. That changes from the 1st of May under the simplified process for internal market movements for not at risk movements. And then if the goods are coming in from the rest of the world into Northern Ireland, if those goods are deemed to be at risk of entering the European Union, EU tariffs apply, third country tariffs, erga omnes, most favoured nation tariffs apply rather than UK tariffs. Next slide, please. So what does this actually mean? The exports from Northern Ireland to the USA, this is a very, very quick high-level recap of what Anna has said earlier on. If we go to the next slide, please. Due to the fact, well, as stated clearly in Article 4 of the Northern Ireland Protocol, Northern Ireland remains part of the customs territory of the United Kingdom, and as such, as a part of the United Kingdom, our goods are deemed to be UK origin on export, and therefore when our goods enter, be it the US market or any other market, if there is a free trade agreement, our goods can benefit from that. And if we meet the requirements, as Anna spoke about, around non-preferential origin, our goods can be declared as UK origin, with the caveat around substantial transformation and all of those areas that Anna spoke about earlier. Next slide, please. This is just very quickly putting this up here. It's a plug for the NI Business Info. This has got the most up-to-date information around US trade tariffs and what is happening in terms of tariffs being applied across sectors, reciprocal tariffs being applied, baseline tariffs, updates on any news around semiconductors, pharmas, exemptions, and so forth. Next slide, please. So as I said, the focus that I am going to have on my presentation today is around direct and indirect imports of US products into Northern Ireland. And the indirect element is as important as the direct element because there are implications when it comes to Northern Ireland. Next slide, please. So I spoke very briefly there about the difference of goods moving into Northern Ireland being declared as at risk or not at risk. This is unique in the world of trade in terms of how goods are categorized. So what does that actually mean, and how does it differentiate the way that goods moving in to Northern Ireland from movement of goods from Great Britain to Northern Ireland, and then the import of goods from the rest of the world, i.e. outside of Great Britain and the European Union into Northern Ireland. So next slide, please. In terms of not at risk imports, goods that are not at risk of entering the European Union, that have been classified as being not at risk of entering the European Union, meet the prerequisite requirements to be declared not at risk of entering the European Union. If they're coming from Great Britain into Northern Ireland, they will already be in free circulation within the internal United Kingdom market, and therefore no tariffs will be applied. And from the 1st of May, no requirement to complete import declarations, including supplementary declarations. Those will be replaced instead with IMI's, internal market movement information requirements. If they're moving from outside of the EU and the UK, UK tariffs will apply on those goods, and we can benefit from UK free trade agreements if they're not deemed at being at risk. And if they had moved in transit via the GB land bridge into Northern Ireland, they would be treated as being they will be treated as a UK import, and therefore UK rules and in terms of rates and all will apply. Next slide, please. At-risk imports, they're treated differently. As already mentioned, at-risk goods will be charged the applicable EU rate of duty, and this includes any additional country-specific tariffs. I'm talking about trade remedies there in terms of any anti-dumping duty that we have with Chinese origin goods impacting a lot of my clients currently. And if those countermeasures that were published on Monday of this week by the European Union come into play, and we have rebalancing tariffs applied against the US, those will apply as well when the imports come into Northern Ireland. Next slide, please. For the last, we've had 2021, 22, 23, 24, and we're into 25 now. It has been a real area of controversy around the definition of at-risk and not at-risk goods and how you differentiate between both. And again, if we go back to the Northern Ireland Protocol, Northern Ireland Protocol stated that there would be a risk test carried out, but at the time that protocol was published, the second element of it had been undefined, and they had indicated that goods would be considered at risk. All goods would be considered at risk if they were commercially processed in Northern Ireland. In fact, as recently as July 2020, the EU at that stage had indicated that all goods moving into Northern Ireland, be that from GB or rest of the world, would be declared or defined as being at risk. But then we had the negotiations that took place between Cepovic and Gove back in December 2020, and then we got some exemptions and some other thresholds in that. So next slide, please. This is a quote that I've used often. It's directly from correspondence that I had with the Trader Support Service team, and HMRC, I understand, were involved in this response that was provided to me. And essentially what it's saying is, you cannot declare goods as not at risk of entering the European Union if you do not know at the time of import in its entirety where those goods are going to go and where they're going to remain, i.e. within the internal UK market, and that you will be able to hold for a period of 5 years evidence to support that claim that they are not at risk. If you are bringing in goods that you do not know at the point of import that where the final destination, the final customer for those goods are, you cannot declare them as not at risk. You can, if you have some goods, if you're bringing in goods and you have some of those goods that have already been sold to a customer, you may have the potential to separate those in item lines and declare those goods as not at risk if you meet all other prerequisite requirements for eligibility requirements around UKIMS. But you cannot declare. It doesn't matter if they are 1% of your sales are in the European Union or 99% of your sales in the European Union. In fact, if you just make your goods available for sale in the European Union, that makes them considered as at risk. Next slide, please. As I mentioned, there's a prerequisite requirement to be able to declare goods as not at risk, and that prerequisite requirement is that you are signed off for the UK Internal Market Scheme. Next slide, please. UK Internal Market Scheme replaced the UK Trader Scheme, and from the 1st of May, the additional benefit of UKIMS for those traders who do trade entirely, wholly, purely within the internal United Kingdom market is that they will no longer have to complete supplementary declarations, import declarations on GBNI movements. But UKIMS also UKIMS registration is also required to be able to benefit from paying UK tariffs, UK global tariffs on goods being imported into Northern Ireland from outside of the UK and the European Union. Next slide, please. I looked at the list of industry, or the industries, not the specific companies that are involved in this today, and we have a lot of manufacturing companies, and I am no doubt they will be well aware that a UKIM certification has additional requirements for commercial processors. On top of that requirement that your goods will only be sold and are for consumer end use within the internal United Kingdom market. For commercial processors, there is an additional requirement. Next slide, please, and you can actually move on 2 slides. The next slide. There is additional requirements, and the main one is this threshold of 2 million turnover. If your company is not involved in one of those exempt trade sectors and your turnover in the last financial year was more than 2 million, even if you only sell your goods within the internal United Kingdom market, you cannot declare your goods as not at risk under the UK internal market scheme. This has been gone back and forth. There has been a number of companies that I'm aware of that have tried to get a dispensation around this in terms of being able to show, set out a legal agreement, a legal contract that they will only sell their goods within the United Kingdom. But that 2 million threshold was set for some reason within the Windsor framework. FYI, it was previously 500,000 under the original Northern Ireland Protocol arrangement. There is some exemptions, however, where the 2 million threshold doesn't come into play, and those are around construction, food for sale to end consumers in the UK, healthcare, where the products that are being manufactured, healthcare goods moving in for healthcare, non-profit industry, where those goods that are being manufactured are not then for sale, and then animal feed, be that the importer or one further entity thereafter. Next slide, please. This is the part that's most important. I had to put the context in because I've no doubt I would have had questions, but there is goods that will be automatically deemed at risk of entering the European Union when they come in. And there's 2 areas that I wanted to highlight here when it comes to automatically. I referred earlier to the fact that the UK government announced in the last couple of days, published a list of duty suspensions to come into effect until 2027 for 99 or so commodity codes. And I got this confirmed yesterday. Were the suspended rate, which is now 0 on those goods, is 3% or higher, 3%, how to get my words right. If the EU tariff is 3% or higher than that 0% tariff, those goods are now deemed to be automatically at risk of entering the European Union when they move from the rest of the world into Northern Ireland. If they're coming from GB and they've already been cleared into free circulation in GB before moving to Northern Ireland, that requirement doesn't come into play. But for rest of world to Northern Ireland movements, because if that rate with the suspended rate is 0, if the EU rate is 3% or higher, they are automatically deemed at risk and therefore cannot be declared under as not at risk. The countermeasures that are currently suspended by the European Union mean that if they come in to operation in 90 days time or even beforehand, if they come into operation, those counterbalancing or rebalancing or trade remedies applied by the European Union against US goods make those goods automatically at risk. That means that they cannot be declared as not at risk, and therefore the companies that are bringing them in will find that they have to be declared as at risk and either waive the tariffs, which we're going to talk about, or pay the tariffs and then try and reclaim it through the duty reimbursement scheme. So next slide, please. So we're going to look at mitigating risk and how companies can take practical steps. Again, I'm really re-emphasizing some of the points already made by Anna in her presentation earlier. Next slide, please. A recommendation that I make to companies all the time. It doesn't matter if it was post the US tariff announcements or pre-US tariff announcements. In fact, it's the first thing I do in any onboarding call with any new client, is we look at their supply chain and trade flows. So we're looking at where their suppliers are located in Northern Ireland, in Great Britain, in Ireland or elsewhere in continental Europe, and the rest of the world. We're looking at the type of movements that they bring in. We're looking at the size and value of those movements. And as Anna mentioned earlier on, we're looking at the Incoterms. For those movements that require customs to be carried out, be that GB to NI movements or rest of world, i.e. non-UK, non-EU movements, who is responsible for completing the import customs paperwork? Who is responsible for paying any associated tariffs? Who is responsible in terms of any licensing regulatory requirements and ensuring that those are met and any undertakings, etc., have been met? Next slide, please. Sorry, next slide. Okay, thank you. So when you're dealing with your suppliers, what information are you getting from them? Are you getting Incoterms? Are you getting commodity codes, the correct harmonized code nomenclature code for your goods? Are you getting an 8-digit code? Are you getting a 10-digit code? Have you checked that code? If you ever have a compliance review, the areas that always come up in a HR compliance review are around use of the correct HS code, commodity code, correct country of origin for the goods, correct customs valuation for the goods, and have you included all the correct rates in that, be that transport costs if they were separate and so forth. Information and regulatory compliance, dealing with a company over the last couple of weeks, bringing in goods that had undertaking requirements because of the type of products. Who holds those registrations and undertakings? If you don't hold them and you're the importer of record, you're taking responsibility. You're leaving yourself open then for challenge, be that by HMRC, be that by compliance officers, environmental compliance officers, or anybody else through the councils and so forth, whoever polices those things. Next slide, please. In that commodity code review, are you using the correct commodity code classification for your goods? And as your customer or your supplier, but we're going to focus here on imports in. So how have you checked the commodity code that has been provided to you? Is it worth considering here in Northern Ireland making an application to HMRC for a binding tariff information decision, a BTI? For the rest of the UK, GB, it's an advanced ruling. Here we have BTIs. My understanding is that there is no charge for applying for BTI. The charges would only apply if there is any testing required for the products that you bring in. But that will give you some comfort and confidence that you're using the correct code for the products that you bring in. This has come up many times in recent weeks around products that had associated anti-dumping duty, and it was very, very specific on the products that anti-dumping duty applied. Anti-dumping duty in some cases of 46, 47%, where the previous rate had been maybe 0%, as in the standard base rate or most favored nation rate for those products. Have a look at those and review those. as Anna said, in terms of the US, but equally important when you're bringing goods into Northern Ireland. Have you considered all the associated tariffs and potential future rebalancing tariffs? I recall back in June 2021 working with a company that was bringing in US products, and under President Trump's first period of US president, there was measures, counter balancing or rebalancing measures applied by the European Union on goods at that point of around 25%. The good that they brought in was a high value goods. They were about 40, 50,000 pounds in value, significant for them, a finished product. The standard tariff on those goods was 2 point something percent. However, they ended up having to account for 25% rebalancing tariff that had been applied by the European Union. If they hadn't been able to use their waiver on that, they would have sold the product for less than what it cost them. So be aware of all associated tariffs. Check them regularly. Look at your products. Make sure that you're declaring the correct country of origin, your supplier is providing you with the correct country of origin for the goods. The importer of record will be responsible. As I mentioned, ensure that the correct valuation of these goods has been provided as well. Next slide, please. Contract review. Is there a chance now to declare force majeure? Is there time now to look at additional costs in your contracts? I worked in the commodities industry for many, many years. I was involved in importing multiple million-dollar cargoes in, and force majeure we had to use on a number of occasions. Review of quality specifications had to be used on many occasions. We reviewed our letters of credit to ensure that payments were not released until the terms of the contract were reviewed. So this is very, very important. And this is a really good time to sit back and look at your contracts, look at the terms that you had previously, and look at what you need to add in light of the potential additional costs that could be applied on your imports going forward. Next slide, please. So we're down to my last two slides, and apologies if I've run over a little bit here. I know that there has been questions asked previously, the webinar today around the duty reimbursement scheme. The duty reimbursement scheme, it has a repayment turnaround period, which is up to 100 days. It was mentioned last week in the event, the webinar by Anne and Stuart for Northern Ireland Chamber, that HMRC have now managed to get that down to 16 days. I spoke then on Friday with my contacts in HMRC to reconfirm this, and that was confirmed that they are confident that even if the EU do introduce countermeasures impacting US imports coming into Northern Ireland, that they will be able to deal with a legitimate, eligible claim within 16 days. The duty reimbursement scheme have additional requirements in terms of notification to your customers around where trade remedies are being charged on goods. There is additional requirements for commercial processors and how the evidence that you must provide to them to show that your goods have either remained within the United Kingdom or they were sold into the rest of the world. And this is all around documentation, ensuring that you have the correct documentation. These schemes are fantastic in paper. As Anna has already said, it's ensuring that you get them to work in practice for you. And you do that by preparing, by putting the right information in, and processes in place, by liaising with HMRC and others to ensure that you're doing things right and that you can be successful with your claim. The waiver is a much easier way to mitigate against these additional costs. The waiver allows you, at the point of declaring the goods as at risk, to use the Northern Ireland Additional Information Code NIAID to waive the associated duty on those goods, including any rebalancing tariffs, countermeasures that may be introduced by the EU 90 days time in back end of July this year. You then do not have to hold any evidence of where those sales went into. However, announcement earlier on or made at the end of last week was that instead of it being a 300,000 allowance covering the current financial year, which started on the 6th of April, and the previous 2 financial years, which would have meant that you were looking at any de minimis state aid that you receive between the 6th of April 2023 and the 5th of April 2026. We have now been confirmed, it has now been confirmed that it's working on a rolling 36-month period, and this is not a benefit. In fact, I know of many of my client companies who were waiting to move product until after the 6th of April, when any of the de minimis state aid that they'd received between the 6th of April 2022 and the 5th of April 2023 would have dropped off their undertaking. Unfortunately, it's now a rolling 36-month period, so you need to be very aware of that. Do also consider special customs procedures, such as inward processing relief, which suspends, does not remove, suspends at the point of import the duty payment on the goods brought into Northern Ireland. And then depending on where those goods, the final product is sold, and based on your application, the tariffs that will be applied is either on the component parts or on the final product, if that is lower, and that will be outlined in your application. If the goods were sold in the UK, you will pay UK appropriate tariffs or applicable tariffs. If they were sold into the EU, you will pay applicable tariffs for those goods. And then for the rest of the world, no tariffs will be applied at all. However, obviously, the importer in those countries will have to pay their country-specific tariffs. Look at things like the duty deferment account. Duty deferment account requires here in Northern Ireland, and the general guarantee account require a guarantee, comprehensive guarantee from your bank or your insurance company. So look into that. It is a complicated process. Again, just be very aware. And not always HMRC will be as up to speed with it, and the unique differential between Great Britain and Northern Ireland and those requirements for comprehensive guarantee account, which doesn't apply up to £10,000 in the Great Britain. Final slide, please. Quick recap. Do you know the key components to make up your finished product? Have you assessed and looked at it? We are at a bit of a disadvantage here in Northern Ireland, that where the rest of the UK, I'll just go back and say that we're at a disadvantage in that we haven't had to worry about rules of origin when selling into the European Union like our counterparts in Great Britain have. And they have been assessing and looking how they met preferential rules of origin requirements, whilst we didn't have to. So look at what components go into your product. Look at where each of those components come from, the country of origin, the value element of it. Look at the value add element of it. Review, as Anna said, with regards to exports, but equally in terms of imports, rules of origin requirements when you're bringing the goods in. Do they meet preferential origin? If they meet, here in Northern Ireland, preferential origin is UK origin, but de facto having access into the European Union, either the statement on the invoice or a certificate of origin. Whilst this is not US specific, look at speaking to, would it be advantageous to speak, sorry, the slide lost the last of that, speaking to Northern Ireland Chamber. Would it be advantageous to speak to them about their export documentation services, for any of those markets that you sell into? And then, as well as our dual market access, which gives us access to 515 million people, a market which includes the 27 member states of the EU, the EEA members, and obviously our internal United Kingdom market. And would undoubtedly point out that the UK have access to 39 free trade agreements, and Northern Ireland has access to these free trade agreements. So look at what other market opportunities there are for you and work with InvestNI and others around support. I've gone over the line, sir, a bit, my time limit, my apologies. Hopefully that was useful, albeit it was a very whistle-top run through it. And thanks to Anna, and thanks to InvestNI.